Hi, this is Greg Brady, video of my first presentation for Federal Financial. Scott, how are you today?
Good.
Great. Hey, I want you to know I really appreciate the opportunity that we have to get together. I don't know if what we have will be a fit for you, but what I'm going to do is cover a few areas that we work in. Areas such as increasing cash flow, decreasing debt, reducing taxes, and we also specialize in life insurance and annuities and how they can take years off of your retirement date. If there's some interest on your part, what we'll do is we'll gather some information. We'll get back together again in a few days and we'll go over some of the specifics if that's okay with you.
Absolutely.
Today, though, what I want you to know is that there's nothing to buy. So just sit back and relax and we'll go through the presentation here. Shouldn't take too long.
Okay.
That sound okay?
Sounds great. Yeah.
Great. First of all, what I want you to know is I want you to know a little bit about who Federal Financial is. Okay? Federal Financial is a national company that represents several large insurance companies and financial institutions. These are A-rated, A-plus rated companies, companies that have billions and billions of dollars of assets. These are big, big companies. And many of them have been in business for over 100 years.
Wow.
So what we do is we teach people about how money works, how it works, and how to make it work better for you. Okay? So specifically, we have one main goal, and that goal is to help people become financially independent. Okay? So what I'd like to do is just quickly ask you a question. What does financial independence mean to you?
Wow. Financial independence to me would be having enough money to, of course, cover all my bills, and then having discretionary income to do things that my family and I wanted.
Okay. Well, you know what? That's great. That really is a very good answer. Well, to me, what it means is that when the interest that you're earning on your investments or the money that you got put away, when that interest or that money replaces the money that you would normally earn from your salary or from your business. Okay, does that make sense? So when that interest on your investments is making more for you than what your salary is, well, that's what I call financial independence. And at that point, Scott, that's when you have a choice. And the choice is this. It's simply, do I work or do I not work?
Yeah.
It's your choice, and that's the question. To work or to not work. And so to me, that's what financial independence means, and that's where we're going to be headed in this presentation.
That's great.
Sound good?
Yeah.
Okay. So before I get into the specifics, though, what I'd like to do is I'd like to talk about some of the issues and the challenges that we face in our country today.
Okay.
I'd like to take a few minutes and talk about some of these issues and challenges. And let me start with this. Over the last 2 years, the last decade has been kind of volatile, in our country and with our economy. We've had two major market crashes. As a result of that, people, their savings and their retirement plans just are not quite performing the way that they would like them to. Something, I'll give you a little fact here. From 2008 to 2011, the last market crash was in 2007, 2008. Well, from 2008 to 2011, $400 billion was taken out of the stock market and simply put into their savings accounts, or some people moved it into bonds. But the point is this: they moved it out of the stock market and moved it into low interest earning accounts. And mostly the reason was because of the volatility of the market. Investors were afraid of the high risk market, and they moved their money out of that $400 billion out of the market and put that money into low interest earning accounts in the banks and CDs and money market accounts and bonds. Well, that creates a problem. Another issue is this: incomes. Have they risen? Well, they've risen somewhat, but they haven't risen at the same rate as the cost of living. We call that inflation. For the last 50 or so years, the rate of inflation has been about 3% every year on average. Well, that takes me back to those people that moved all that money out, that $400 billion out. They're earning less than, in most cases, probably less than 2% in CDs or in their savings accounts in their banks. So that presents a problem. So, let me ask you this. What happens when your monthly expenses exceed your income? When your monthly expenses exceed where your income is, what happens?
I go into debt. I start using credit cards.
Absolutely. That's absolutely. People go into debt. And you know what? That's what's happening in our country. People are going into debt, and that creates problems. This is my point. Let me ask you this. Out of 100 people turning 65, how many do you think would have a retirement income of $35,000 or more? Out of 100 people turning 65, meaning that they're just now going into retirement, how many do you think would have a retirement income of only $35,000?
20, 25.
You know what? That's a good guess, and that's probably what most people say. 4 people. 4 out of 100 have a retirement income of $35,000 or more. You know what that means? That means that 96 out of 100 don't. 96 out of 100 don't. So that presents problems.
Yeah.
You know what? And it even reminds me. I saw an indication of this just this last week. I'm one of those people that likes to. I go to Walmart a lot, and when I shop for my groceries at Walmart, I tend to go at midnight. I go in the middle of the night. Usually, there's less people in the store. But what also happens at midnight at Walmart is that people. That's when the people are stocking the shelves. That's when the workers at Walmart are stocking the shelves. Okay, well, I'm there the other night, and I'm going down an aisle. And here's a woman. She had to be 70 years old. I'm not kidding. She had to be 70 years old. She was in pretty good shape, but she had to be at least 70 years old. A pallet of boxes. She was opening up the boxes and stocking the shelves. And I just looked at her and I thought, somewhere along the line, the system has failed her. Now, it may not have been poor retirement choices on her part, but something happened along the line. I'm sure when she was 30, 40 years old, she didn't think that when she was 70 that she would be working at Walmart stocking shelves at midnight. Okay? Well, so that's where we're going. We've got solutions for that. And that's the good news, is that there are solutions to some of these problems, these challenges that we're facing in our economy. Okay? So what we're going to talk about today is we're going to talk about 7 steps that involve key areas that we've already discussed. The areas that we've discussed. Areas such as increasing cash flow, again, getting out of debt, reducing taxes, and we're going to do this in such a way to help you retire. Our goal is to help you retire financially independent and help you retire as soon as possible. Okay, so what I'm going to do is I'm going to rip through these 7 steps, pretty quick. But I want you to keep something in mind. As we go through these 7 steps, I want you to to identify the areas, the steps that have the biggest priority for you. Okay? And then what we'll do is when you identify those, pick 1 or 2 of the 7 steps, then we'll develop a strategy and we'll address it. And we'll get back together and meet again. Sound good?
Yeah, absolutely.
Okay. So step 1 is what we call inspect what you expect. Okay, inspect what you expect.
Makes sense.
What we talk about here is in order to have more money, okay, later for your future goals and dreams, you need to know where it's going. Doesn't that make sense?
Yeah.
So what we have at Federal Financial, it's kind of neat. We have a free tool to help you track your earnings and expenses so that you can inspect what you expect. And our goal here is to free up extra cash that you didn't know that you had to help you pay off that debt. Okay, so or let me say it this way. What we want to try to do is we want to take that money that we can find and help put it to work for you in a retirement plan that can satisfy what your future goals and dreams may be.
Okay.
Okay?
Yeah.
That sound good?
Yeah.
Okay, so that's inspect what you expect.
All right.
Okay. Our second step is what we call cash flow. Okay? So cash flow, this is the second step. This is about actually increasing your cash flow. So let me ask you a question. How would you define cash flow?
The amount of money I earn. I don't know.
Well, that's good. Yeah, the amount of money that you earn. I would define it like this. It's the money that's left over at the end of the month after all of your expenses and bills are paid.
Yeah, that makes sense.
That makes sense. Okay, so every month, you earn money, but then you also have these expenses, all these bills. You have this amount that comes in when after all of your expenses and bills are paid, then what's left over, that's your cash flow.
Yeah.
Okay? Well, let me ask you another question. At the end of the year, we just, here we're coming up on the end of April, so we just passed tax day.
Right.
Do you get a tax return?
Yeah.
You do. Can I ask approximately how much you're expecting to get back this year?
I think this year is probably around 2,000.
2,000?
Yeah.
Okay. Well, you know what? That's really neat. But let me kind of share a thought with you. I met with another client just the other day who also was getting money back on their taxes like that.
Yeah.
Do you realize that that money that you're giving to the government, you're giving them that money to let them have that money to use it to earn interest on for over a year, and then you let them give that money back to you at 0% interest? Does that make much sense?
Not really.
Could there be a better use of that money?
For sure.
Okay.
Yeah.
Well, here's what's neat. There are ways of taking that money as it's earned and putting it into a budget to earn interest for you. Okay, instead of for the government. Now, does that make sense?
That makes perfect sense.
Okay. Well, again, that's the step of cash flow and understanding how much of your money's coming in, where it's going every month.
Yeah.
Establishing where that cash flow is, trying to find more of it to increase it for you, and then put it to work for you so it'll work better for you.
Right.
Make sense?
Yeah.
Okay. Well, step 3 is called the debt eliminator, and this is kind of a neat step. What we do here is this is another kind of a free program that we offer. We use this in such a way that we help people identify where their debt is. Sometimes people money comes in and money goes out, and they don't really know exactly the status or where their debt's at. So we help people identify their debt. Then if and through this debt eliminator that we have, it's kind of a software program that we use that we can plug in all of your payments of your debt. Well, if you will continue to make the same payments following our plan, then it'll help you get out of debt in half the time. That's kind of the way the program works. It's kind of a unique plan. So let me ask you a few questions.
Okay.
Do you own your home?
Yeah. Well, I have a mortgage.
You have a mortgage.
Yeah.
Okay. How much is your mortgage?
$797 per month.
That's the payment.
That's the payment.
Okay. Do you ever double up on your payment or pay a little bit more?
No.
Okay. You make the exact payment every month.
Yeah.
Okay. Do you have any car loans?
We have one.
One car loan, and how much is that?
It's $262.
Okay. And how many years left do you have on that car loan?
2.
2 years left?
Yeah.
Okay. Same question again. Do you ever double up on that or,
No.
or pay a little bit more to it? Okay. Credit cards. Do you have any credit cards or store credit cards?
No credit
No,
cards.
you're clear there. Okay.
Yeah.
That's good. That's good. Well, basically, again, what this step is for, the debt eliminator, is identifying that, kind of just going over those questions that I just asked you, and basically it's a tool to help manage your debt, and then find a way to eliminate it sooner than you normally would have.
Sure.
Just making your minimum payments the way that you are now.
That'd be great.
Okay.
Yeah.
Okay, great. So that was step 3. Step 4 it's kind of this is kind of one of my favorites. This is called the emergency fund.
Uh-huh.
Okay.
I've heard about something like this before.
Yeah, this is a big one. This is, this is where you actually create an emergency fund of cash. Okay. And what I find is that most people don't have one. Now, do you have anything like that right now?
I mean, we
Other
have a savings account, but I mean that fluctuates just because we're not aggressively saving right now. So
Okay, and that's what I find with most people that I meet with. Typically, what happens when an emergency comes up is what? Out comes the plastic.
right,
Right.
right,
Out comes the plastic. And I've experienced this myself. You have typically it happens with your cars. You have a major repair with the car, like a transmission. The transmission goes out. It's $1,800. Rather than paying the cash for it, out comes the credit card, thinking I'll put it on my credit card and I'll pay it off in a year. I'll make payments so that I pay it off in a year.
right.
Well, what usually happens? Well, you don't pay it off in a year. It ends up taking you 3 or 4 years, and so that $1,800 transmission ends up being a $2,000 or $3,000 transmission. Okay, that's why there's a great need for an emergency fund. And so what we try to counsel people to do is with their emergency fund, it should be 3 to 6 months of income. Okay, and it should be there are four basic points to an emergency fund. It should be, number one, it should be safe. It should be liquid. It should be in a vehicle that earns a better rate of return than what your checking or current savings account would earn at your bank. And then it should be systematic, meaning that you should be putting a set amount of money into that account on a systematic basis every month.
I see.
Okay, and do that until you've reached a point to where you've got 3 to 6 months of this cash put away, and then that creates your emergency fund. Then when you have that $1,800 transmission or a new set of tires, or you've got to replace your air conditioning unit, well, rather than put it on your credit card, then you'll have that emergency fund to pay for that.
Yeah.
It'll keep you out of that. It'll keep that $1,800 transmission from being a $3,000 or $4,000 transmission. Okay.
That makes sense.
Okay, so that's the emergency fund. Good thing. Next step, again, is one of my favorites, and it's one of my favorites because I've got really some personal stories regarding this. And this is step 5. This has to do with life insurance. Okay.
Okay.
You're a young man, 29 years old, I'm guessing.
Mm-hmm.
Okay, married. Any children yet?
No, not yet.
No children yet. Life insurance provides the proper protection against loss of life, okay, which leads to loss of income.
Right.
Okay. Personally, this is really important to me because I have really 2 stories that relate to life insurance and how life insurance can play an important role in someone's financial plan. I had an older brother that at the age of 42 was very physically fit. He was even a professional football player, and had 6 kids, wonderful family, and he was playing basketball. He was playing in a city league basketball game, had a massive heart attack and died right there on the basketball court. 42 years old. You know what? Devastated his family. And you know what? He didn't have life insurance. He didn't have life insurance, and it really created a problem that I can look at certain aspects of his family today that have to do with the difficulty that put their family under by not having life insurance to cover things such as simple their house and their basic living expenses and their food and their college education and things of that nature.
Yeah.
It really put a bind on their family. My second story, again, it has to do with a family member. I had a brother-in-law this time. Again, he was 43 years old. Again, had a heart attack, heart failure, passed away. Again, 6 kids, wonderful family. And he had life insurance. And it's been a blessing. But even with his life insurance, you know what? In some respects, we can look at it now. It wasn't enough. I mean, his wife still is kind of month to month, and they're still struggling, but it still was able to cover certain basic um, living expenses and housing expenses that it's been able to create a fund to allow their kids to go to college and do some things that that I'm sure he would have wanted them to do.
Right.
And so it's been a real blessing. Here's my point. Regarding life insurance, every good financial plan should incorporate life insurance to replace, for this reason, to replace the loss of earning power. Okay, so that's life insurance. Something I'd like you to really think about.
Absolutely.
Okay, well, this takes us to step 6. This is probably most people. This is their favorite step. This is where we talk about long-term savings and long-term income. Okay, and I want to just say this: if you'll listen to me, if you'll listen very carefully to me during this step, it could change the quality of your life. Okay, and this is something that I wish, I'm in my early 50s. This is something that I wish I would have sat down with someone and learned about this step when I was 30 years old. Okay, this is because we're going to cover some really important stuff. This is going to be really exciting. And again, like I said, this is the one that most people really likes the best. Step 6, building long-term income and building long-term savings. You see, to do that, there are 2 basic elements at play here, or 2 battles that have to be won to win the money game. Okay, because if you don't incorporate both of these, okay, now can I be strong with you?
Sure.
Okay.
Yeah.
If you don't incorporate both of these and win both of these battles, the chances of you being financially independent probably just won't happen. Okay? So this is some important stuff. The 2 battles, these are what the 2 battles are. The 2 battles are the 2 battles that you must win are the inflation battle, okay? Okay, how fast money, the inflation of money. And the second battle is the tax battle, okay? Because it's not what you make, but it's what you get to keep, okay? And taxes will really hurt you if you don't plan for them.
Right.
Okay. So what I'd like to do first is talk about inflation. Okay.
Okay.
Great. Let me ask you this: have you heard about the rule of 72?
I've heard of it. I've dealt with it a little bit. If I was asked to explain it to someone, I probably wouldn't be successful.
Okay. Well, you know what? It's really simple, and that's what we're going to do here. We're going to talk about the rule of 72.
Okay.
It's kind of neat. They say that Einstein developed this concept. I'm not sure if he did or not, but people like to say it. It sounds kind of neat. Okay.
Right.
But the rule of 72 is this: that the interest rate that you earn on any investment that you have, the interest rate that you're earning, okay, if you divide that into 72, that it tells you then the answer there is the number of years it takes for your money in that investment to double. Okay?
Okay.
Again, the interest rate that you're earning divided into 72, well, the answer will tell you the number of years it takes for your money to double. Okay? Here's a simple way of looking at it. If you were earning 4% interest, okay, if you were earning 4% interest and you had $100, okay, 4 goes into 72 18 times. That means it takes, at 4%, if you were earning 4%, it would take 18 years for your money to double. Okay, got that? So if you had $100, okay, in 18 years, how much money would you have? If you had $100 earning 4%, it would take 18 years to double to get to 200. Okay. That's how this works. 4% into 72 is 18 years. So if just a simple illustration is $100 would take 18 years to get to $200. Another 18 years would be how much? You'd have how much?
400.
Exactly, 400. So in 36 years, it would take 36 years at 4% to go from $100 to $400. Let me ask you a question. Do you think you could buy that you could in 36 years you could buy with $400 what you can buy today with $100?
I hope so. Probably not.
Probably not. Yeah, that's right.
Yeah.
Probably not. 36 years, that's a long time. At the rate of inflation, the answer is probably not. Okay, so just to give you another illustration, let's talk about it this way. Okay, earning 4%. Let's just assume for a minute you're 29 years old.
Okay.
Well, which you are. Okay, at 29 years old, let's take $10,000. Let's say you had $10,000 to invest.
Okay.
And you're investing at 4%. Okay, in 18 years, you would be 47 years old, and following that rule, for your money to double in 18 years, you started with 10,000. In 18 years, you're 47. How much money would you have?
20,000.
You'd have $20,000.
Okay.
Right. Okay. Follow me?
Yeah.
Now, in 18 more years, you're going to be 65. Okay. Your money's going to double again in 18 years. So you're going to have now how much?
40,000.
You're going to have $40,000. Exactly. So in 36 years, from age 29, starting with $10,000 to age 65, planning for retirement, you're going to have $40,000. Let me ask you a question. You think you'd be able to retire? How long could you retire with $40,000?
Not even a year.
Probably not even a year. Exactly. So you'll in a year you'd be 66 years old, and you'll have zero left in your retirement fund.
Yeah.
That's kind of scary, isn't it?
Yeah.
It is. Let's look at another. Let's look at another example.
Okay.
Show you how this works. Now let's just take for example, another 29-year-old, one of your best friends. He's 29 years old. Only he found an investment strategy that he could earn 12% interest. Okay, we're going to show you how just changing the interest rate can make a difference.
Yeah.
Okay, he earns 12%. Well, we know that 12 goes into 72. Again, following the rule of 72, 12 goes into 72 6 times, which means that now it's only going to take 6 years for that same amount of money to double. Okay?
I see.
So now he starts at 29 years old with $10,000. Within that same 18 years, okay, when he's 47, his money has doubled 3 times. So 10 to 20, 20 to 40, 40 is now 80. So when he's 47 years old, he has $80,000 where you had 20.
Jeez.
Pretty amazing, isn't it? Now, but look at this. Now in 18 more years, when he's 65, that $80,000, again, in 18 years, it's going to double 3 more times. Now when he's 65, he's going to have $640,000 where you had $40,000.
Jeez.
That's a $600,000 hit for you versus what he earned simply because of a greater interest rate.
Yeah.
Okay? Now don't you think that's a pretty important principle to understand, don't you think?
Absolutely.
Absolutely. Well, let me tell you, this principle alone could change the quality of your life. It could change the quality of your life. And you know what? Here's the thing. It's not about saving $10,000. Okay? The key here is about saving a little bit of money on a monthly basis at a decent rate of return. And you know what? If you'll do this and save for you at a decent rate of return, there'll come a time when your money will be out earning you. Kind of what we talked about earlier. Okay? When your money can out earn you, what does that mean? We used this term earlier. That's when you'll be financially independent.
Yeah.
Okay? And that's where we're headed. So, the $1 million question here is, where can I get a decent rate of return while keeping my principal protected from losses, guaranteed? Okay, that becomes the $1 million question. See this. You were earning 4% interest, and you saw by the time you were 65, A lot of people think 4% interest isn't a bad rate of return. But when you look at a decent rate of return at 12% interest, we're talking about $640,000.
Yeah.
That's huge. Okay.
Yeah.
So how do we? So where can we find a vehicle or a strategy that can get a decent rate of return in a strategy that also protects the principal and protects it on a guaranteed basis? Okay. That's where we're headed right now. Okay. There's three basic strategies. Okay, Scott, there's three basic strategies. The first one is the fixed strategy. Okay, and the fixed strategy is this: banks, credit unions. Okay, these are savings accounts, CDs. All right, safe investments, but they earn low rates of interest, usually less than 2%.
Yeah.
Okay, but that's $400 million was taken out of the stock market, like I told you earlier. From 2008 to 2011, 400 million or billion was taken out and put in to the banks, into CDs and money markets earning less than 2%.
That's crazy.
That's crazy. Okay. Now, on the far end of the spectrum from that, the second place that you can put your money is in the stock market. Okay. You can put your money in the stock market. Here's the thing: in the stock market or mutual funds. Okay, that's where you also have your 401ks, right? You probably have a 401k, don't you?
Yep.
Let me ask, you have a 401k. How much money do you have in there right now?
I think it's around $8,500.
Okay. How long have you been with your company?
3.5 years.
Okay. Is the company matching any of that?
I think they match up to 5%.
And a full match to 5%, or is it a percentage up to 5%? That's kind of what I'm seeing a lot.
Yeah.
It's probably a percentage up to the 5%.
Right.
Yeah. Okay. Well, that's another place that people put their money for retirement, is in the stock market. And the thing about the stock market, it has the potential for a high rate of return, but it also has the potential for downside risk.
Right.
And has that happened?
Yeah. I saw a huge hit.
It has happened. It's happened. In fact, it's happened twice in the last decade.
Yeah.
And you saw a hit on your account not too long ago.
Yeah.
Absolutely. Okay. Well, you know what? There's a third strategy, and we call that the indexed strategy. Okay. Now, the index strategy is this. The index strategy means that you can invest your money in a vehicle where it's tied to the market, or it's linked to the market, but not actually invested in it. And in most cases, it's tied or linked to the S&P 500. It also can be linked to the Dow or the Nasdaq. Okay, and if your account can be credited interest based on the upward movement of the market. For instance, the S&P 500.
Yeah.
But here's what's neat: is that the index strategy has a floor. It has a floor, which means that when the market crashes and goes down, that you're guaranteed not to lose any money. Your principal is guaranteed, but also your growth or your interest is also guaranteed. Okay, That's what's neat. Now the growth part of the index strategy, as the market goes up, for instance, the S&P 500 goes up, your account value gets credited interest based on that growth. Now, because of the floor, because there is a floor guaranteeing that you won't lose any money in this account, okay, the index strategy has a cap on the growth, which means that if the S&P 500 should happen to go up in 1 year, say 15%, well, most companies have a cap of somewhere around 11 or 12%, so that your account would be credited interest of 11 and 12% in a year where the S&P 500 might be at 15% or even more.
When was last year the S&P hit 15%? It's like,
well, yeah, but it's happened.
Yeah.
But it's happened. And so the point that I'm making is that you have a floor to protect you from the downside risk. But for the company, in return for giving you that floor, that protection, they're putting a cap on your growth. So when in a year, in those years where the S&P should have a fantastic growth,
Yeah.
your growth will be credited at 11 or 12%.
12 still solid.
That's still absolutely. I think it's a fair. I think it's a fair exchange
Yeah.
for that floor or that guaranteed no loss of principal, don't you?
Absolutely.
Okay, so that's the index strategy. Okay.
Okay.
So let me just ask you real quick. Out of those three strategies where you can invest your money, the fixed strategy, which are the banks, the credit unions, where you have no risk at all, but you're probably earning less than 2%, versus the stock market, where you have the potential for high upside, but you also have the potential for an extreme downside risk in the market as well. And that's your mutual funds, your stocks, actually, investing in the S&P 500, 401ks, IRAs, and so forth. Or the index strategy, where you have the potential for growth capped based on the S&P 500, but also you've got a floor protecting you against any loss of principal or even the interest gain. See, the interest that's gained in this on a yearly basis, those gains get locked in as well. Okay, so once you have that gain, you don't ever lose that as well. So of these three approaches, what approach would be most interesting to you? Which one would you choose to put your money in?
I'd choose the index.
You choose the index?
Yeah, for sure.
I think that's what most people choose. It's becoming a really popular strategy for people to put their money. Okay, let me show you. Let me just kind of draw this out so you get a better idea of how this works.
Sure.
Okay. This is really neat. We're going to draw a little graph here. Okay, we're going to start with $10,000. At this point, at $10,000, and we're going to say year 1, year 2, and year 3. Okay. Now, what I'm going to illustrate for you here is the actual chart path of both an index strategy tied to the S&P 500 and actually having invested in the S&P 500 directly. I'm going to show you the charts of both.
Sure.
Okay. So let's say the first year there was a 10% growth in the S&P 500. 10% growth. Okay. That means both the index strategy and the S&P would have gone up and would have gone to $11,000.
Mm-hmm.
Okay. Now in year 2, let's say there was another. Want to make this look good here. There's another 10% growth. Okay. So again, both the index strategy. Okay, this is under the cap. So both the index strategy and the S&P would both go up together 10%. Okay.
Okay.
So where would that take us then?
12.2.
That would take us to 12.2.
Or 12.1.
12.1.
Yeah.
Okay, you're better at math than I am. Okay, so now we've had 2 consecutive years of 10% growth, right? So both the index strategy and the S&P 500 have gone up 10% both years, and they're both sitting here at $12,100. Now that third year, the S&P, okay, takes a 17% loss. Excuse me, a 20% loss in year 3. Okay, in that 20% loss, the S&P is actually going to drop down to $9,600 in that third year.
Yeah.
Okay, but what happens? Remember, I told you that with the index strategy, there's a floor.
Right.
Okay, so during a year where the market crashes, your account value in an index strategy will simply go sideways. No loss of principal and no loss of your interest earned up to that point.
Yeah.
Okay. Now, let's say the next year there was a 15% gain in the market.
Yeah.
Well, that S&P index is going to gain that 15%. Okay, and be somewhere right around there. Okay, but you're also going to gain not 15, but you're going to be capped at 12. So you're going to gain your 12%. And you're going to be right there. Now, would you rather earn 12% from your 12-1 or 15% from 9600. The visual is pretty self-explanatory, isn't it?
Yeah.
Yeah. So that's how an index strategy works versus actually being in the market. Does that make sense?
Makes perfect sense.
I think you made a wise choice.
Yeah.
Okay. Okay. So so that raises the question, and the question is $1 million question, and that is, where can I get a decent rate of return? Again, and keep my money guaranteed.
Yeah.
Okay. Well, I think this is the answer, don't you? We talked again.
Well,
we talked about the fixed. We talked about the indexed, the fixed, the stock market, and the index strategy.
Right.
And I think that works. Okay. Now let's talk about. I think we've shown how we can beat the battle of inflation. Now let's talk about taxes.
Yeah.
Okay. Let's talk about taxes. Let's build a story here for a second. Let's say there was a gentleman 30 years old, and he walked into his bank. Okay, this is a 30-year-old. He wanted to earn $1 million. He won't by the time he was 60. So in the next 30 years of his life, he wanted to know how much money he needed to put away to have $1 million when he was 60. Okay, so he goes into his banker. And he says, "Mr. Banker, I want to know how much money I need to put away on a monthly basis, okay, to have $1 million when I'm 60 years old." And the banker says, "Okay, well, give me just a minute." He sits down with his computer and he calculates, some figures, and he comes back, and he says, "Well, sir," he says, our current CD rates are 5%. He goes, "And if you put your money here with us, if you'll just put $1,639 away every month at 5% interest, by the time you're 60 years old, you'll have $1 million." And that 30-year-old gentleman looked at him and just said, "What do you think?" he said.
"I don't have $1,600 a month.
I can't put $1,639 away. That's crazy."
Yeah.
And so he got discouraged, and he got up and he walked out of that bank, and he never put any money away for retirement. In fact, he's probably a greeter at Walmart.
Yeah.
You've probably seen him.
Yeah.
Okay. Well, let me just show you a little bit how this works. Well, so changing that interest rate. We've just talked about interest rates a little bit. Changing the interest rate from 5% to 10%. Let me show you what that does. Just changing the interest rate for a 30-year-old, putting money away monthly, he would only need to, going from 5% to 10%, he would just have to put $900 a month away for that $1 million. Well, that's huge. So wouldn't you agree?
Yeah.
That that from $1,639 to $900, that's pretty big time.
Yeah.
Okay, but here's the thing about taxes. Earning that same 10%, if the growth in your money, if you could put it in a strategy where the growth of that money is now tax deferred, it takes that payment from $900 a month to $438 a month.
Jeez.
Now that's pretty amazing.
Yeah.
Now, do you know anybody that could afford $438 a month?
Yeah, for sure.
I bet you might even be able to afford that much.
Yeah, I mean, I had to figure it out, but I could.
Get rid of a few credit cards, get some things paid off. You probably could put that much money away.
Yeah.
Well, the point is that you probably either you or you probably know someone that can do that. But isn't it amazing? $438 a month versus $1,639 a month, simply because of a better interest rate, which we've talked about,
right?
And because that money is now tax deferred.
Huh.
Okay, pretty huge.
Yeah.
Okay, well, let me talk about one more little, so here's the thing. If you were able to find a strategy or an investment vehicle where you could put money away tax deferred, but also pull the money out in retirement tax free, how would you feel about that?
Tax free. So like when I take it out, I'm not paying taxes on what I take out.
That's right.
That'd be awesome.
That would be awesome. Well, you know what? Let me write this out for you. Let me show you something. This is kind of neat. I call this the perfect savings or retirement plan. This is the perfect savings or retirement plan. There are three separate areas when with regards to your investment. You have the contribution phase. There are three phases. You have the contribution phase. That means when you put the money into any type of an investment.
Right.
There's the accumulation phase, which is the growth. That's where your money grows.
Mm-hmm.
And then there's the distribution phase. Okay. Now, again, the first phase is the contribution phase. Okay. Now, the perfect in the perfect tax or savings plan, the contribution phase would be the money would be with pre-tax dollars, or those, in other words, those dollars would be essentially tax deductible.
Right.
Okay. Okay, that's the way it is with your 401ks or your IRAs. Okay, put money into a 401k or an IRA.
Right.
Okay. Now, step two, which is the growth or the accumulation phase, is where your money grows tax deferred. Okay, the money you put in grows tax deferred. Same way it is with your IRA or your 401k, right?
Right.
Okay. Now, step three of the perfect savings or retirement plan is where that money can be taken out or distributed on a tax-free basis. Okay, wouldn't that be the perfect savings or retirement plan?
You bet.
Where the money is put in with pre-tax dollars or tax deductible, or number two, well, not or, but and the accumulation phase, the money grows tax deferred, and then the third phase, the money can be taken out tax free. Wouldn't that be the perfect tax plan?
Yeah.
Unfortunately, that plan doesn't exist. Unfortunately, that plan doesn't exist. However, there are plans that exist with two out of the three. Okay. Now let me ask you this: if you could have a plan choosing two out of those three, what two would you choose? Now right now your 401k, you say you have a 401k, that money is going in, being contributed with pre-tax dollars.
Right.
Okay. And it's growing tax deferred. But the distribution of that money, you can't take it out tax free, right?
Right.
Okay. But if there was a plan that the money could grow tax deferred and be taken out tax free, just what plan would you choose? What two would you choose?
I want tax free distribution. And I don't want my growth.
And you'd want tax deferred growth.
Yeah.
Okay. Wise choice. And you know what? And if I told you that there was a plan that we could accomplish that for you, would there be any reason why you wouldn't want to participate in that plan?
No, I'd want to take a look at it, and I'd want to get started.
Okay. Well, you know what? That's where we're headed. And when we get back together again, what we're going to do is I'm going to gather some information in a few minutes, and when we get back together in a few days, I'll show you a plan where your money can do just that. It can grow tax deferred. First of all, you put the money in with after tax dollars, but then the money will grow tax deferred, and when you go to access that money for retirement or even for any other use that you might have, a child's education, home repairs, purchase of a home, you can take that money out of your account tax free.
Jeez.
Okay,
Awesome.
You'd be interested in something like that.
Yeah.
Okay. Well, that's great. You know what? That's step 6, and that's what we're going to show you when we get back together again, is how a plan like that could work for you.
Okay.
Okay. Now, just to conclude, step 7 has to do with estate planning. Okay, estate planning meaning setting up your a will, a trust, things of that nature for you. Do you have an attorney that you work with that that would have the ability to set up a trust or a will for you?
Yeah, I actually do.
He's an estate planning attorney, I assume.
I think he does that. Yeah.
Okay. Well, that's great. And you may not quite be in a position right now, to do something like that, but just know the importance of that, the importance of setting that up. If something were to happen to you, and your estate's gotten to the point to where you have some real net worth and some real asset value, you'd want to know that those monies and those assets are going where you want them to go.
Right.
And that's where a trust can take care of that for you.
Yeah, I don't think I'm quite there yet. But
okay.
That's good to know.
Okay. Well, that's great. Well, Scott, I appreciate the time you've spent with us today. I want you to know that. In fact, let me ask you this real quick. I mentioned to you early on that we're going to cover 7 steps, and I wanted you to, as we went through these 7 steps, I wanted you to identify, 1 or 2 that had a particular priority to you. Of those 7 steps that we've covered, could you identify what 2 would you like when we get back together again? I think I pretty much know step 6 is one area they're very interested in.
Yeah,
is there another area in there, another one of those steps that you'd like me to come back and share some information with you?
Definitely step 6, and also the emergency fund.
The emergency fund?
Yeah.
Okay.
Both of those are things that are high on my priority list right
now. What? That's great, and we do have some ideas with the emergency fund areas where you can put your money, that it's safe, you can put it in systematically, and it earns a higher rate of return than your checking or your savings account does at your bank.
Yeah.
And
that's what I'd like.
Okay, we've got some great ideas for you there as well. So what? Just 2 more questions quickly, and we'll be through here. From what you've seen, particularly with that step 6, if I'm able to bring back a plan that answers every question that you had regarding a long-term savings and retirement plan, and it's a plan that can just as you chose there, those 2 items, the 2 out of the 3, meaning a plan that had tax-deferred growth, that offered you tax-free distributions, at the same time gave you a guaranteed protection of your principal and your growth on a yearly basis. If I could show you a plan like that, would there be any reason at all that you wouldn't want to do business and sign up for that plan?
No.
Okay.
No.
Okay, that's great. And then number 2, if when we're through doing business after we meet next week, would there be any reason why that you couldn't come up with the names of 3 or 4 people that you might know that could benefit from what we've talked about today?
I know a lot of people that could.
Okay, that's great. I would appreciate that. That would mean a lot.
You bet.
Okay. Hey Scott, thank you again very much, and we'll get back together in a few days, and I'll have some plans and some illustrations set together for you.
That'd be great. Hey, thank you.
Okay.
Thanks a lot.
Thank you. Have a good day.
Yeah.